Hi, everyone. This is Jason Bjork of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is currently Chief Strategist at Macro Lens, and his China analysis has been featured on Real Vision TV for years now. And from 2011 to 2018, he was Chief Strategist and Portfolio Manager at Emerging Sovereign Group, where he managed the Nexus Fund, a China-focused macro hedge fund. Brian McCarthy, thank you for joining me again.
Jason, good to be here.
Now, Brian, there's a lot happening in China the last couple months. What do you think are the biggest problems in the Chinese economy right now?
Well, I think there's one gigantic, enormous, massive problem, which is China is now on the backside of what is probably the biggest real estate bubble we've seen in modern economic history. So, we can talk about the zero COVID stuff. I'm not of a mind that is really driving the slowdown in the Chinese economy. It's a contributing factor, but the real main dynamic at play is that sentiment in the Chinese real estate market has finally broken in a way that Humpty Dumpty is not going to be able to be put back together. There were some rumors just this week that maybe they're finally ready to relent in terms of the policy clamp down on real estate. I'm not convinced that's going to happen, but even if the government does start to loosen policy towards speculative purchases of real estate, there's just no appetite at this point because sentiment has now, the tide of speculative sentiment has ebbed and is receding. So this is creating a similar dynamic to what we saw in, say, Japan or US or Europe in the wake of big real estate bubbles, which is a deflationary credit dynamic. Now, of course, how this plays out in China is going to be different and probably something we've never seen before because of the different features of the Chinese credit system and its sort of top-down, centrally controlled nature, which does not mean they can defy gravity. Okay, these asset prices, people don't want to play anymore in terms of speculating in domestic real estate. The clearing price of Chinese real estate is probably half current levels, if I had to guess, given the extent of the overbuilding there. They're unlikely to let markets clear because when markets want to and need to do disruptive things to clear, they prevent that because they don't like the instability that would entail. So I don't think there's any way they can or will allow residential real estate to trade at 50 cents on the dollar. Therefore, the market will never clear. And we're going to see sort of a different dynamic than we did, say, in the U.S. in the wake of the 2007-2008 housing bust. I think it's going to be more like Japan in terms of sort of a deflationary ice age, as the term I'm using of late to describe what I think the Chinese economy will look like over the next decade or so. But all of this comes with a very wide band of uncertainty because, again, we've never really seen this kind of thing happen in a centrally planned system because a reasonably functioning centrally planned system never would have let this happen in the first place. So they enjoyed the little taste of the free market when everything was bubbling up and people were feeling richer and getting richer to some extent. But to the extent that dynamic of the population getting richer stemmed from asset prices that are now proving to be unsustainable, that dynamic is going to have to be reversed. And obviously that brings with it all kinds of potential social pressures, which is why they're going to resist this. So it's going to be absolutely fascinating to watch this unfold, I would say, over the next several years. I don't think there's going to be the kind of Lehman-esque cataclysm some people have been looking for out of China for the last couple of years. It's going to be more of a slow descent into a deflationary ice age is the way I'm describing.
And before we start recording, I asked you about strategic defaults, because here in the United States, during our housing bust, a lot of people who are upside down in their mortgages either stopped paying their mortgage or they just literally walked away, handed the keys to the bank, and that was a strategic default before they started changing the laws. Now, that's not allowed in China, right?
Right. So most mortgages in the U.S. and I think through much of the West are non-recourse. The bank has recourse to the asset collateralizing the mortgage. They can take your home. But if your home's worth a lot less than you owe, then it is strategically wise to walk away. If you don't think the price is going to come back, obviously, that will ruin your credit score. You'll have a default on your record. It'll be hard to get a credit card. But if you're a couple $100,000 underwater and you're, that's like sort of approaching your income level or exceeding it, then it makes sense to walk. And that is what we saw in large numbers in, South Florida and some of the hotter, more bubbly spots, Las Vegas and elsewhere that had a spectacular bubble that burst. In China, there is recourse. The bank has recourse to your entire balance sheet. So it's not, the loan is not simply collateralized by the piece of property you're purchasing, but it's basically collateralized by every other asset you own. And furthermore, it's collateralized by your social credit score, which is, if they decide that mortgage defaults are something they don't want to happen, then they'll just say anybody who defaults on a mortgage, can't use a debit card at an extreme. I mean, they can, can't do anything, can't fly, can't travel, can't get a job. Who the heck knows, right? Because they have pretty good control over, what everybody's balance sheet looks like. They're not quite yet at the point of institutionalizing a digital currency, which would allow them to basically wipe out your currency holdings. But, that's coming soon too. So this is why, so to close the loop on that, you can't just walk. And defaulting on a mortgage has really serious ramifications for your personal finances, your lifestyle, and many aspects of your life in China, which is why this recent movement, this protest movement to stop paying mortgages was a mind blower. I mean, just incredible sign of desperation on the part of these people who, not only feel like the market let them down, but they bought apartments that are going to be worth a lot less than I thought if they ever get completed. The real problem is that some of these people made these purchases in, say, 2016, 17, 18, expecting the apartments to have been completed 1, 2, 3 years ago. And they're still, driving by and staring at an empty shell in the sky. And it's increasingly obvious these things are never going to be completed. And the argument that these home buyers have made, which is a fairly solid argument, which is why they're getting some policy response, is, hey, I gave that developer a deposit. I was told that money was going to be held in escrow. That was the rule. So the bank who let the developer use those funds to go buy more land and run another round of speculation when they never came back and finished my building, well, that's the bank's fault. The bank let the developer skirt those rules. And I have my mortgage with that bank. So screw you. I'm not paying that bank. Like, get that money back. That money, my deposit is supposed to be in escrow. Everybody knows it's gone. And this was an open secret. I mean, everybody knew the developers were flouting these rules as a means to essentially maintain a higher degree of leverage. So these homeowners, it's not just they made a bad decision and bought an apartment that's collapsed in value, or not just that they made a bad decision and bought an apartment from a developer that's now defaulting. They put down a down payment that has disappeared, that they technically have a right to. It's in escrow until these apartments are delivered, and they're now 1, 2, 3 years late in delivery with no sign of finishing them. So this is a story that sort of emerged on the scene, I don't know, about 3 months ago now, and was a hot story for a couple of weeks, and it's sort of gone quiet. We see news stories eke out in Zhengzhou, which is where this was sort of the epicenter of this, where they this week announced they've got a plan to provide some state capital as equity to developers to get these things going again. And oh, by the way, hey, developers, if you don't get these buildings finished, we're going to start investigating your tax returns and everything else, because everybody knows all of these. Well, I don't want to paint with too broad a brush. The vast majority of these developers are, stink to high heaven in terms of their, fiduciary soundness and their degree of responsibility with the funds to which they were entrusted, and just generally skirting every regulation in the book. So the municipal authority is saying to the developers, well, if you don't finish these apartments, we're going to nail you to the wall because we know you've broken all the rules. Well, all right, that's good. That's a stick they can use, but it's like it's going to be getting blood from a stone, because now that the pre-sale model, okay, because everybody knows these pre-sale funds, the rules have been skirted, and now you're taking credit risk to a developer that nobody wants to touch the credit risk. This whole model of putting up, a third of your deposit in pre-sale and getting a mortgage is dead now. So this is a whole nother, there's a whole round of financing that the developers are going to lose, because nobody's now buying apartments on pre-sale. So the merry-go-round has stopped for these guys.
Yeah. Sorry to interrupt you. So for the mindset in China for the last 15 or so years was that real estate prices only go up. It was very similar in the US during the US housing bubble, and that seems to have stopped. And now they're dealing with all of these repercussions. They're looking, it's the old Warren Buffett quote, you see who's swimming naked when the tide goes out. They're starting to look at all the accounting fraud, the bribes from Evergrande, problems with Chinese state-owned enterprise banks, and those types of problems now.
Yeah, the problem is everybody's naked. and really out of shape. It's quite a sight. And again, it's not the least bit of a surprise to somebody like myself and others who have been following this story closely for the last decade or more. I mean, everybody knew that the developers were wildly over-levered, that they were using these pre-sale funds that were supposed to be held in escrow to lever up further. Everybody knew that momentum in the Chinese real estate market was simply self-feeding, that it was a speculative frenzy born of widespread moral hazard, much like the bubble, the 2000 bubble in the U.S. Remember, U.S. home prices have never fallen year on year. It can't happen.
Yeah, Ben Bernanke kept mentioning that.
yeah. And in China, it's the government will never let this happen. And I have to admit, to some surprise, that the government has finally pulled the plug. I mean, I knew they would take it to the bitter end. I didn't know where the bitter end would be. I mean, it became a sort of damned if you do, damned if you don't for the authorities. I mean, the overriding objective of the Communist Party of China is to maintain power, and to feel safe in doing that, they really are phobic about any kind of instability in either political or economic dimensions. And this housing bubble was, when I say damned if they do, damned if they don't, they couldn't control it. So they couldn't control it on the upside. The market had them by the short and curlies, basically, where it was we're just going to keep buying stuff because we know you'll never pull the plug, because you can't. And then finally they said, well, if we never pull the plug, it's going to go to infinity. We own the whole thing. We got to show the market who's boss and make it be a market for a while and pull the plug. Well, there's no easy way to do that. There's no pain-free way to do that. And more importantly, there is no reform program or anything else to take over in terms of a growth engine. It was just all bubble. And I have to say, I've been saying for the better part of a decade, this idea that they're going to reform into what? Reform into what? A market economy? If you want to pull the moral hazard and let the assets clear and let the market do its work, then you're going to have a deflationary wipeout. And if you want something to hand off to, it needs to be a more efficient market-oriented system where credit is allocated based on entrepreneurs' best guesses at what activities will satisfy the wants and needs of consumers. That's how market economy works. That's why consumption is 70% of GDP, because we have a finely tuned system of efficient investment predicated on satisfying the wants and needs of those consumers. Chinese investment is the dominant portion of GDP, and consumption, household consumption is an afterthought, because that system runs on central planners deciding what to invest in, and they're not going to surrender control over the system to the marketplace. So reform was always, there could only be one dimension of reform that's worth talking about. It's called marketization, and that was always going to be incompatible with the degree of market control that Xi Jinping desires and needs to maintain power. So when he first came to office in 2012, 2013, there was a glimmer of hope at the so-called third plenum that announced, all these moves to, marketization, which were all smoke. None of it's come to fruition. And now we can all see clearly that if Xi Jinping wants to marketize, he's going to have to step aside, because it's simply not compatible with his vision of increased statism and a continued high degree of control. So you get the backside of a property bubble with nowhere to go from there. Absolutely nowhere to go other than increasing statism. Like they're on a path. I think the only way they control the backside of this housing bubble is ultimately to become either more like North Korea, or, I guess Xi Jinping maybe thinks that he can build a sort of return us to a Cold War and build an alliance of like-minded, authoritarian-leaning, low to middle income countries where he can sort of afford to continue to put up a wall between himself and market economies. Because if the Chinese currency has to trade in anything resembling a global market, it's not going to be able to withstand what is going to be an ongoing and severe slowdown in the wake of this housing bust.
And we're recording this interview on Friday, September 16th, 2022. The Chinese yuan to the dollar just hit around 7 to the US dollar. I think it's the lowest foreign currency exchange in about 2 years. At these levels, the Chinese citizen, if you have a lot of Chinese yuan in your bank account, you're worried about potentially the banks failing with falling real estate prices, needing bailouts. You're worried about the currency getting weaker against the dollar. What options does a Chinese citizen have, Brian?
So to be fair, the dollar's strong against everything. And in fact, the weakness in the RMB to this point is basically consistent with broadly the weakness of everything else against the dollar. So now there was a little bit of volatility this week because we got the first cut in retail deposit rates in the banking system since 2015, I believe it was. So they cut by 15 basis points the 3-year deposit rate, 10 basis points, I think, on the 1 year, which doesn't sound like much. But again, this is the first cut in 6-7 years. There's going to be more to come. It's only going in one direction. And households have been stuffed with funding all of these bubbles, the infrastructure bubble, the real estate bubble, funding the inefficiencies at SOEs and everything else, largely by being stuffed with household deposits. So it's essentially a big experiment in MMT, modern monetary theory. The IMF estimates that if you include local government debt and local government financing vehicles, which are off balance sheet but quasi-government, that China's been running budget deficits in the mid-teens going back almost a decade. We're talking 12 to 18% of GDP year in, year out. To the extent they finance, to the extent they sell bonds, much of those are bought by banks, which are funded by the creation of household deposits. So the system is hypersensitive to these deposit rates because that is ultimately the funding for almost all of this bubble. And once those rates start going in reverse, as they did this week, the system's going to be very, very sensitive to that. So we did see heightened volatility in the RMB. We blew through 7 this week. So I don't want to discount that something is happening with the RMB. But if we look back over a year or two or more, the RMB against their trade-weighted basket is sort of sideways in a range for a year, and it's higher than it was 2 years ago. So, we haven't really seen anything you could call RMB specific weakness. I would say they're suffering the strength of the dollar like everyone else is. And if you look at Japan, dollar yen at 143 here, even more so. So we haven't really seen an RMB episode yet. Maybe the deposit cut this week will trigger one, but why haven't we? A few reasons. The pandemic was very, very good for China's balance of payments for two main reasons. One, they were suffering prior to the pandemic leakage in the triple-digit billions via tourism expenditure. So not only did Chinese, had increasingly liked to go abroad and spend money, but they might go to Hong Kong and buy, a bunch of Rolexes as a way to sort of diversify their asset base, or I don't know, buy a Monet or whatever when you're in France. So they spend a lot of money when they're on these trips, and a large portion of it is hidden capital flight in one form or another. Well, if you can't leave, you can't do that. So shutting down outbound tourism as, let's call it, $100 billion annual benefit to China's balance of payments. And the other big balance of payments benefit from the pandemic is that the Europe and the US are not spending money on services. Now, this is just starting to normalizing more slowly this year than I would have thought, because goods spending is still at extreme supernormal rates. Now, it's coming off the boil a little bit, but again, because of the pandemic, we all got stuffed with stimulus payments, and I couldn't go to a Grateful Dead concert like I like to on occasion. Couldn't go out to eat and things like that. So you couldn't spend that money. So, everybody basically did home improvement products or whatever else, all of which involves importing oodles of crap from China. So China's trade deficit, it came off a little bit in August. The July number, I think, was the first $100 billion monthly print. But there's been a well over $500 billion swing in China's trade surplus as a result of the pandemic. So tally it all up, and you've got several $100 billion of balance of payments benefit China has derived from the pandemic. Now, that should normalize, although on the tourism front, there's no sign they're going to let people travel the world anytime soon. Although Xi Jinping did leave the country for the first time in a couple of years, so maybe that's going to loosen up. We'll see. So, you've got hundreds of billions of dollars more than you would have expected flowing into China. Now, the flow of foreign money to purchase Chinese bonds has dried up. So that's cost them $100 billion plus over the last 12 months or so. And this situation is going to start to turn against them as we start to buy more services and less goods here in the West, which is underway. So a big positive boost to their surplus the last 2 years, which has helped them to manage the currency to sort of no worse than weakness against the dollar than anyone else has seen. Now, that dynamic is going to get harder for them to maintain because these pandemic-driven flows should start to normalize, and we'll see their trade surplus start to come down, particularly if Europe and the US go into recession, which I think is likely in 2023. So So it's a more problematic backdrop from a balance of payments perspective going forward, which will require, more onerous capital control methods. And to summarize China's capital control policy, it's basically when people want to buy dollars and they call ICBC or Bank of China, they tell them don't pick up the phones. So the capital controls are really a blunt instrument. I don't even like to use the term capital control because it implies they can pick and choose which flows they want to allow and which they want to prevent. They really can't. They just say, they try to pick a range for the exchange rate, and they tell the banks, well, whatever dollars flow in at this rate, you can let that many dollars flow out, and that way our balance of payments balances, and the rate is fixed. So to put this in perspective, they've had a big advantage in their balance of payments. Their balance of payments is balanced. So all those extra dollars have come in, they've flown out one way or another because we know their FX reserves are not changing and the currency is about as weak as everything else. So if the balance of payment advantage stemming from the pandemic dissipates in 2023 and the Chinese economy sucks wind and the US and Europe go into recession, so we're not buying as much stuff from China, yet the Fed's really overcooked it, which is something we can discuss, which they're on path to do. So they're leaving rates too high. The dollar continues to be strong. Then we're setting up into 2023. And it may have started with the deposit rate this week. We're setting up into 2023 for the potential for an RMB episode, like an RMB specific episode. But to be fair to this point, all I can really point to is broad dollar strength when I look at the RMB, even at a rate of 7.0.
Yeah, so there was weakness in the Chinese yuan, in 2015, 2016, and that was one of the first major banking crises that happened prior to 2019 with Bank of Jinzhou and some of the other problems.
Yep. That was a very China-specific, I shouldn't say completely China-specific episode. We were in a period of dollar strength then, and China was trying to maintain a more rigid fixity against the dollar, which they tried to get out of, and it blew up in their face. So they reverted to fixity in 2016, 2017, and they have done a little better job of allowing some volatility, but it's nowhere near a float. It's nowhere near a free float. They're allowing a little more noise on a day-to-day or week-to-week basis around ranges that they want to control. And so, as the pressure continues for China on the backside of this housing bubble, just increasing pressure to really try to keep the market liquid when if home prices are wanting to fall, they're preventing them from falling by fiat. That's going to make those assets really, really illiquid. Basically in a deflationary environment, the desire to invest is going to be greatly, greatly diminished. So now they're trying to stuff credit into lower and lower return projects. So like more make-work infrastructure projects and less anything resembling private sector activity. Because in a deflationary environment, what are you going to invest in China? There's nothing to invest in. So it just becomes all or largely centrally government dictated infrastructure, which we know has lower and lower return on investment because, the first airport's a great investment, the second one not so much, and the third one's a complete waste of money, and they're now on the third one. So this is going to cause great liquidity problems, almost a pushing on the string problem for the PBOC. Despite the degree of central control, they look like they're in a pushing on a string problem. And, monetary policy is going to have to get really aggressive in terms of easing to prevent that. So it does shape up for a very, very rough, end of the year and into 2023 for the RMB. Let me make one comment before we lose track of it on this pushing on a string phenomenon, because there was a story related to Chinese housing. Bloomberg had it. I think it might have been covered in a couple other places a few weeks ago, which after 10 years of watching China is just sort of one of those things that makes me sit up and say, oh, wow, that's interesting. Widespread repayment of mortgages by households. So, aggressive deleveraging on the part of households because there's nowhere else to put your money. I mean, if you have a mortgage and they're going to make you pay it and it's at 4% or something, where are you going to put that money? That's a better risk than that. It's basically 4% risk-free if you know they have a gun to your head and you have to pay it come hell or high water. So, I mean, pretty interesting that Chinese households, just even the speculative types who probably own several properties, are saying this is over now. There's nothing left to speculate in. So let's delever and try to survive.
Yeah, and you have Chinese technology companies that are firing enormous amounts of people. So I would also argue not only is there a China housing bust, there's also a Chinese technology bubble bust too as well. So a lot of Chinese households are buying a lot of physical gold. Fred Hickey just put out a tweet in the last 48 hours. He was talking about premiums for physical gold in Shanghai. They've gone, I think, from $12 an ounce premiums at the wholesale level a month ago to $40 an ounce premiums in the last couple of days, which is insanely high.
Yeah, I mean, I couldn't say that if you were a decent sized or mid-sized company in China with access to some capital or credit, something like hoarding copper is probably not the worst trade in the world. I mean, even though China is going to be using a lot less copper, and I wouldn't pretend to be a copper expert. Personally, I'm bearish right now because I think the Fed's they're moving us into deflation next year. But if you can't get money out of China, you can't buy real estate. The bank accounts are going to pay nothing. I mean, you can leave buried cash in a coffee can in your backyard, I guess, or you can pay down your mortgage. Or one way to protect against the devaluation is to just buy stuff, whether it's iron ore or copper or anything for which there's an international market you can access to get cash. It's just an indication of the poor menu of options in terms of a store of value for Chinese with wealth to try to protect.
So if home prices are falling, the stock market in China is not doing well because of their technology companies laying off so many people, there's a potentially currency devaluation with falling real estate prices. Do you think that the banks in China, the Chinese state-owned enterprise banks, are they going to need bailouts? Is the People's Bank of China their central bank? Are they going to have to do some type of bailout scheme like quantitative easing or accounting rules changes similar to the Federal Reserve Bank in 2008 and 2009?
Yeah, well, when push comes to shove, the rules in China aren't worth the paper they're written on. So there's that. I've been touting in my newsletter shorting Chinese banks for over a year now, and it's like I think it's the only trade I've been consistent on over the past year. To be honest with you, it's been a crazy market, but I think this is I term it a cover at zero short. Because we're on the backside of a housing bubble. We know how this ends. The banks in China aren't as egregiously levered as some of the Western banks who, hit 40 or 30 or 40 times leverage. But still, the assets are going to get, if they allowed the market to clear, the assets would get cut in half. They won't allow the market to clear. So this dynamic is still problematic for banks. The market, if real estate's trading at par and nobody wants to buy at par and we need to trade to 60 cents to clear, and they say, well, we're not going to let anybody sell below 80 cents, then what happens is transactions just completely dry up. The market grounds to a halt. Those assets become completely illiquid, like infinitely illiquid. You literally can't sell it. And I've seen, I saw this in Ordos in, I think, 2014, it might have been, where like they had a huge localized bubble. It collapsed. The bank said, no, everybody let's just mark these things at par. And, so you had like, as far as the eye could see, boarded up, fenced around property developments that were shells of buildings marked at par. and everybody in town was like, the balance sheet was fine and they were completely broke because they had no liquidity. So I think that's, they'll do extend and pretend for, it could be forever, I don't know, for years. So whether they actually mark down the capital of the banks is not entirely clear to me. I'm not sure that's going to be the outcome. But they'll just bleed to death basically, because the balance sheets need to continually expand. But I'm hard pressed to see how it happens. They need to pump out credit to avoid a debt deflation. But the only, as I mentioned a few minutes ago, the only repository for that credit is going to be centrally planned investment with, at this point, not low, but probably everybody knows negative returns. So it's just unclear how long they can continue down that path to me. So ultimately, they have to continue to grow the funding base, which is household deposits, by double-digit rates. That limits the degree to which they can cut those rates. So if the banks can't cut their funding costs, and nobody wants to borrow money at a reasonable spread to those funding costs, I'm not sure how the system keeps spinning. It's really, again, as I said at the top, we've seen this dynamic in market economies. We've never really seen it in a controlled system like this. So I think the banks are just gonna sort of bleed. Like the net interest margin will continue to contract because they won't be able. They'll have to cut lending rates faster than deposit rates, which is sort of what we've seen, where the lending rates come first, and only after, like, I'm sure the banks behind the scenes were kicking and screaming that they needed these funding rates cut, and then they cut 15 basis points and the currency starts to act up. So this is the pickle they're in. So I think the banks are just going to bleed. I don't think we'll get write-downs, because they'll just basically pretend the assets are at par. But again, to return to the cost of that policy, is the assets become completely illiquid because no one wants to trade at par. They want to trade at 60 cents. So, this is a debt deflation dynamic. It's sort of I guess they can sort of, I think to say they could do the Japan thing is generous, I think, because I think it's actually much more extreme than Japan. And I think it's going to be more of a North Korea thing, because, Japan never really had to shut down their capital account. And Japan never saw capital flight, right? They had a deflationary deep freeze where their own investors were happy to hold the currency at negative rates. That's not going to happen in China. So it's a sort of a Japan path that needs a North Korea combination, which is ultimately this blunt instrument that they call capital controls, which is really just nobody can buy FX, will force a decoupling. Basically, they can't be the biggest trader on the planet in terms of gross trade flows and have severe disruptions to those companies' ability to trade foreign exchange, which will become inevitable, I think, in the next year or so.
And didn't Japan also transition more successfully to value-added manufacturing? So China has
a real economy. Yeah.
So China hasn't successfully transitioned from low-cost, cheap labor manufacturing to value-added.
No, Japan has real jobs making real things that people both within Japan and elsewhere want to purchase, for sure. And I guess this is an interesting sideline that you bring up here, because Xi Jinping, I'm sure, had delusions that 4 or 5 years ago that by now they would have reached a much higher degree of self-sufficiency than they appear to have reached. Now, there are anecdotes that they've, made some headway in shrinking this high-powered chip and, here and there. But there's also, anecdotes have emerged that this subsidized self-sufficiency program has generated like at least tens of billions of dollars in corruption, like, as they do in these centrally planned systems. You subsidize something, half of it's going to get stolen, and that's happened. So, you add it all up, by all accounts, it doesn't look like they're having much success in achieving self-sufficiency. They're going to be stealing whatever technology they can steal until we shut it off. The Biden administration is talking about tightening restrictions, but to this point, actions speak louder than words, and a lot of this technology is getting through because companies are applying for use of loopholes and getting it, basically. So we'll see. The Biden administration's talking a good game, but the action I've seen is not all that impressive. At least they haven't cut the tariffs, which they wanted to do. But I think one of the reasons Pelosi did the trip to Taiwan was to scuttle that, right? Because she's legitimately a China hawk, and she's also pro-union, and they generally don't want those tariffs cut, and they were going to be cut, but obviously it became impossible after her Taiwan trip. So I think she killed a few birds with one stone there, and one of which was scuttling the tariff cuts, which will probably be back on the agenda after the midterms. So, China is trying to become self-sufficient because I think they see themselves heading down a path where, either by choice or because of some geopolitical action they take, they are under increasing pressure to decouple. But it's not at all clear to me that they're on a path where that's a viable path for them. That said, it's not a viable path for us either at this point, with 8+% inflation rates and all kinds of problems with our supply chains, left, right, and center, and the West embarking on what I can only term an incredibly foolhardy decarbonization effort, which will, whether necessary or not, will only serve to dramatically raise the cost of doing business in the West relative to the rest of the world, because the emerging markets, there's no way in hell they're going to do this. There's no way in hell India, Africa, Turkey, and Brazil, and China and Russia are going to fall on their sword and decarbonize. They're going to laugh all the way to the bank while we try to do it, and they gorge on cheap energy, which is part of this whole photo op you saw in Uzbekistan, Kazakhstan, wherever the heck they had their powwow this week, and is really the core of what Xi Jinping and Vladimir Putin are trying to do in create a commodity. They can create an axis, another pole that is both long commodities and long manufacturing capacity. So the China-Russia marriage is really made from heaven in that respect. And this is why the Brazils and the Turkeys and the Indias and the Africas of the world have no interest in sanctioning Russia. No interest in sanctioning Russia. And I will say, when push comes to shove, no interest in walking over this decarbonization cliff with us. So,
well, I would argue that China doesn't have cheap energy. I mean, I've seen there's a lot of news clips and videos of a lot of Chinese manufacturing centers where they're out of energy and electricity. They're talking about potentially building more coal-fired power plants, even though they said they weren't. It's out of desperation, trying to build more coal-fired and nuclear power plants as well. And I even saw interviews with Chinese factory owners 6 months ago saying that their diesel costs and their electricity costs, if they were even allowed to operate, were up 10x in 2 years.
That's why China's more than happy to see us cut ourselves off in the West from Russian energy, and they swoop in and buy it at a 20-30% discount. They do that trade all day long. They love that. They love that. We're shooting ourselves in the foot, and they're building a new Nord Stream 2 type pipeline. Now it'll take a few years, but that's going to happen. So that is why it's a wonderfully symbiotic relationship, because China's short commodities and Russia needs a customer.
So do you think then that for food, and maybe it's commodity specific then, but you still think then that long term there's going to be commodities demand growth out of China, maybe more for food and energy than base metals?
Yeah, for sure. For sure. I mean, China's going to have a big growth slowdown. That'll affect their demand for everything, for sure. But yes, China is heavily commodity dependent and will remain so for the forever, I guess. It's just geography basically. And there are all kinds of longer term issues with supply of water. Like what is the influence of environmental degradation on Chinese agricultural output? I mean, these are really serious longer term problems. I don't really see those type of things as actionable from an investment perspective, but from a geopolitical perspective, for sure, they have very, very serious problems in that regard, which is why, loop in Brazil, right? All right, the U.S. doesn't want to sell us soybeans. We'll buddy up to Brazil, and I think what the West maybe hasn't quite internalized yet is that these lower to middle income countries they can't afford to play politics with us. They can't afford to do the decarbonization. They can't afford to take some moral stand over Ukraine. I don't know what people in Brazil think. Would they like to see Ukraine win the war? I'm sure they would. Would they rather sell, a lot of soybeans to China? Yeah, that's more important to them. And we might find out in Europe it's more important than we thought too, when the lights go out and the heat goes off. We'll see. But certainly, these lower to middle income countries, they don't have the leeway to be playing these games.
The other problem with China's housing bust I see is that one of the financing methods that Chinese provincial governments were using was that they were rezoning cheap farmland, turning it into rezoned land, selling it to property developers and collecting enormous property property taxes. And then there was a kickback scheme with bribes and other stuff. So it would seem then as if real estate prices do fall or allowed to fall in China, that a lot of the tax receipts that these Chinese provincial governments were relying on, those would collapse pretty quickly too.
Yeah, estimates are anywhere from 30 to 40% of local government revenue is in the form of the sale of land. It's crashed. Another interesting story out this week, which has been kicking around for a while, but is that the predominant buyer of land this year is local government financing vehicles, which is the local government. It's these are off balance sheet vehicles of the local government. So the property developers aren't buying land, but the local government is having the local government financing vehicle, the off balance sheet vehicle, borrow money from a state-owned bank and buy the land. Well, they didn't actually sell it. You can't sell something to yourself. They basically just borrowed against the land, which is collapsing in value. So effectively, if you add the local government debt with the local government financing vehicle debt, they're just borrowing a lot more, which is why, this IMF augmented deficit that loops it all in together is probably going to hit 18% this year, 20% next year. This is insane. So they are racking up debt at a rapid rate. And on the backside of the housing bubble, the 6, 8, 10% nominal GDP growth that they've enjoyed is going to be a thing of the past. So, if you're growing outstanding non-financial credit by 15% and nominal GDP's 4%, your debt to GDP is going pear-shaped. And this is what they're looking at. So yes, the another ancillary problem that arises with the backside of the housing bubble is that local government finances go pear-shaped.
And I think the U.S. will be dealing with something similar at the state and local government level. If we do have a housing bust too, if the Fed keeps hiking rates, we're going to have a real estate bust again too in the next 12 months. And then the state and local.
So this to me is why it's insane that the Fed is obsessing over what they call a broadening of inflation. They're looking at, rent statistics and, 6.5% shelter inflation, when everybody knows that's a result of activity in the housing market 12 to 18 months ago. Today we have a 6.25% mortgage rate, up from 3 something a year ago. The housing market's going to hit a brick wall. So yes, big problem coming in the U.S. Not to go too far off in the China subject, but my view on the U.S. is the Fed is basically predestined to overcook it at this point. We're going to go to a 3 1/8% funds rate next week, most likely, possibly higher. I don't think they'll do 100. I look for 75. My view, that's already too high. It's already too high. We all know that the neutral rate in the last cycle was 2 something. Yes, we had a big burst of inflation, but it was largely a result of the stimulus checks. They way overcooked the stimulus, but that's a one-off. Nobody thinks that's going to happen again. Nobody thinks these inflation rates are anything other than a one-off. And to the extent the inflation is driven by the war in Ukraine or decarbonization or lack of investment in energy, that's a negative supply shock. That's a cost increase, which is an impediment to investment. It's a disincentive to investment to have higher costs, which means the neutral interest rate is lower, not higher. And as much as the Fed says they want to defend an inflation target in the face of a supply shock, it's textbook 101 economic suicide to do so, and a recipe for a very, very sharp recession, if not depression. So the Fed made a big mistake in waiting too long to tighten in the aftermath of the stimulus. And now they're making the opposite mistake. This is a classic boom bust scenario. They're probably going to take the Fed funds rate to over 3.5%, which by my estimate is probably 100 basis points too high. Maybe they go to 4. And then what is there going to be their approach from there? It's going to be to sit there until the shit hits the fan, which is what they do every time. It's why the degree of yield curve inversion we now see in the market is basically a surefire sign that you'll get recession at some point in the next year or so. It doesn't give you a whole lot of information about the timing, because when they invert the curve, they're usually doing it because the economy's got a big head of steam, and they raise rates and they say, well, the economy's fine with a 4% rate. Let's go to 4.25. And they're not sufficiently sensitive to the lags. And it's surprising to me that we have to keep going through this cycle again and again and again. You might have seen Gundlach, Jeffrey Gundlach, said on CNBC this week, the Fed should only hike 25 and then should cool it, because they have to give these policy changes time. There are lags from policy to economic reality to seeing it in the data. And if they don't give it time, they're surefire certain to overcook it. And that's the path we're on as far as the Fed goes, I think.
Well, plus if the U.S. consumer, if they're getting killed with higher rent, higher mortgage, higher food, higher energy, that's less discretionary spending, that's going to destroy a lot of these countries that export enormous amounts of goods, especially discretionary items, especially China, because there's no consumer demand. The consumer lacks discretionary income and savings to go and buy these items. So that's going to hurt emerging markets and China.
Absolutely. So the consumer did get larded up with stimulus. I'd say, probably a $1.8 trillion in personal income above the pre-pandemic trend cumulatively. So cumulatively, U.S. households made $1.8 trillion more, including the stimulus, than they would have if we had just not had a pandemic and stayed on the trend from the past decade. So this is the problem. There is a lot of money in the system. However, ultimately, look, the little guy gets screwed. This always happens. This is like the way of life, right? It's unfortunate, it's sad, but this is what they're doing again. So we have 9% inflation, and now the Fed needs to slow the labor market because we have 6% wage gains. Okay, well, if prices go up 9 and wages go up 3, that means real wages, prices go up 9, wages go up by 6, real wages are down 3%. So what are we talking about, a hot labor market? In a hot labor market, real wages would go up, not down. So why is the Fed obsessing with halting the rise in wages when they're down 3% in real terms? So now Jerome Powell needs to unemploy a bunch of people to make sure that wages don't catch up to prices. I find it sad, frankly, but this is the pickle we're in. So yes, the consumer got stuffed with this stimulus, and then they're going to get punished for going out and spending it, unfortunately. But as always, it's not going to end well for the little guy.
And also then, because the consumer doesn't have the discretionary income, then the emerging markets, China, all these countries that export enormous amounts of items to the US, they're going to suffer as well. They're going to probably take even more brunt of it.
That's the other thing. They always suffer with dollar strength and overly tight monetary policy from the Fed. It's always a problem for emerging markets, which is why at least all these places smartened up and said, no, we're not going to shoot ourselves in the foot with this, like, Russia sanctions either. So, at least Brazil is going to be able to continue to sell their soybeans to China and buy cheap energy from Russia, as is Turkey and South Africa and everything else. It's really, really a mess out there geopolitically, which we could probably do a whole nother hour on at some point. But I mean, the cross currents are fascinating, and we're heading into 2023 with a divergence in monetary policy between the U.S. and China like nothing we've ever seen. So there'll be plenty more to talk about in the next 6 to 9 months, I think.
Yes, and we'll have you back on for more updates on China. I think they're going to have to they have very serious problems with food and energy and the water crisis. I mean, the Chinese, we didn't get to mention this. I'll just touch it briefly before we wrap up. I was surprised they actually talked about it publicly. China's Ministry of Agriculture actually admitted they're going to have bad crop harvest. So that's very unusual for a public admission that they're going to have really bad crop harvest going forward.
Yep. They need that like on a whole head. All kinds of, again, a lot of cross currents, a lot of problems for China. And, I don't see that economy rebounding anytime soon. We've had, I don't know, every like 6 weeks or so, there's another call for, they're going to stimulate, and here they go. They're finally going to get themselves out of this. The Chinese economy has fallen, and it's not getting up this time.
Well, Brian, I really enjoyed our discussion today. If my listeners want to take a look at your work over on Macro Lens or follow you on Twitter, how do they do so?
Yeah, macrolens.com has some sort of somewhat dated archived samples of my work. Brian.McCarthy@macrolens.com if anyone wants to ping me on email, or you can find me on Twitter at Brian Go Bosox. That's BrianGoBosox. Not a good season this year for the Sox, but it's football time.
The Patriots have a long history of winning, though. So
yeah, exactly.
The Red Sox do too, now that the curse is over.
Yeah. Well, thanks for having me on. This was great.